Hey, welcome to the Guarantee Retirement Guy Show. My name is John, and we're going to be talking about if you have $750,000, how much can you get from that for your retirement? So if you're looking for contractual income, if you're looking for generating the most amount of income, then I'm going to lay out exactly what that's going to give you. Whether you're single, whether you're married, we'll talk about both. Okay. And if you watch any of my videos, you'll know that I talk about annuities. Okay. And I love annuity contracts. I love what they can do. I love the stock market as well, but I also love having contractual guarantees so that it clears my mind. So if I want to invest in the stock market and I want to do other things more risky but make some more money, I can do that knowing that I've got my guaranteed income set in place. Okay. And a lot of people I work with want the same thing. So if you're looking for that and you're looking for the most income, then we're going to dive into that together. So also what I would recommend is go to my website, johnstevenson.com, and use my annuity calculators because they are tied into all of the carriers and they will give you all the information that you're looking for as well. So if you don't want to talk to me or talk to anyone else, you can do that as well. It will ask for your email, but that goes directly to me and I'm not going to spam you or I won't even reach out actually. I won't send you another email. It will just send you the actual report. Okay. It'll send you the income report. All right. So hope that is helpful. All right. So I'm going to share my screen and I'm going to show you someone in Iowa. They got $750,000 and they want to invest this into an annuity contract. Okay. They're married and their spouse is 66. So based off of that, they're going to take income in 2 years. All right. So that's what their plan is because they want to wait 2 years. They want to take Social Security at that age. And it's just the perfect age for them to retire. Now, you might be different. That's why I always tell people go use my calculators, plug in your information, whether it's single or joint, okay, and put in the amount that you want to put, whatever amount you want to use for your income, and it'll show you exactly what the payout will be. All right. So we're waiting 2 years, joint income. All right. So we've got Global Atlantic on the top. We've got Corebridge, got North American, we got Nationwide, Nassau, F&G, got Mass Mutual, Prudential, Allianz. You've got a lot of good options. So Midland. All right. So 65,000, that's what we're looking at. We want the highest income. Not bad. All right. We look at that and say, all right, Corebridge Financial, A-rated company, and we want highest contractual income. Looks like they are the highest payout. So you can see here, basically what they're doing is they're growing the benefit base to $900,000. And they're going to multiply that by 7.29, giving you $65,610 for the rest of your life and your spouse's life. Okay, if there is no index growth, then that account balance and the death benefit will last to your 77. Okay, if there is just regular growth, then it'll last till you're like 80. Okay, but either way, the income is guaranteed. That's why you're buying it. So by the time you are 95, it's paid out $1.8 million. Okay, if you live longer, it pays out more. So if you both died, before taking all this money out, then you can see the death benefit right over here. That is going to your beneficiaries. Okay. And that's what's so nice about these. They're just simple annuity contracts. They give you guaranteed income. And the amount that we're looking at, the $65,000, is a net amount to you. You'll also notice over here there is a rider charge. See the charges right there? They're charging you for this. And you can certainly buy an annuity without these charges, but they'll cut your income down by like a third or even 40%. So it just depends on what your goal is. I mean, if you want the account balance to last longer and you're looking for more legacy, that's a great option. But most people I work with, they're looking to use a portion of their money and they're saying, I want the highest income, the end, right? I want the highest income. I can leave my kids the house and the stocks. Like I need income for me, my spouse, whatever. That's what they're looking for. And so when it comes down to that, that's typically why they will choose this. Okay, you'll see the enhanced lifetime withdrawal. That is something that is not there all the time. Okay, it's if you need long-term care or if you can't do 2 out of the 6 daily living activities, then a lot of these carriers will pay out double to you or your spouse. Whichever gets disabled, they're gonna pay it out to you. So they'll double your income, but it's only for a limited amount of time because they are liquidating your account balance. So they're just giving you the money when you need it the most, and then once the account balance is gone, it reverts right back down to the $65,000. So most of you will probably never use this, okay? But it's nice because a lot of carriers just offer it free of charge, okay? So I'll go down here and I'll show you. See, enhanced payments. These are all offering those doublers, okay? So, but they're temporary. They're there for a season and then they're gone. So I recommend if you're looking for long-term care insurance, actually buy a long-term care policy for that. All right. So we'll go back to here and looking at 65,610. I guess you just have to be the judge and ask yourself, is that something that would work for you? Like, would you be like, yeah, that would be nice to have that income, or no, that's not enough, or I'd like to have more growth? Then you might want to just keep it in the stock market or keep it in things that are higher growth, because this is not a growth product. Okay. It doesn't give you a lot. I mean, you can see when it's growing, it maybe gives you 5%. That's not a lot, right? But it's not a growth product. It is for income. You're buying a pension. All right. So I'll go down here and I'll show you real quick. So the benefit base, you might be wondering, how do I get that 900,000? What does that mean? Well, that's what you're buying. You're buying that, plus you're buying the 7.29% withdrawal rate that it is multiplied against. So going down here, let me show you the rider details. Okay, so the income rider is giving you a 10% roll-up rate. Okay, that's what you're paying for. So we'll go right back up here, and you can see, yep, you can see 10%. So they're taking 750,000 multiplied it by 10%. And they're giving you 75 grand a year. Okay. So 825, 900. So that's how that works. And then of course, they're also giving you a higher lifetime withdrawal rate that you would normally have. If you had a no fee option, it would be, both of these would be much, much lower. Okay. And that's how they work. So I hope this is helpful. Now, one thing to remember, I know we're talking about $750,000 here. If you have $750,000 saved for retirement, okay, and you don't have any liquid outside of that, no savings, nothing outside of that. Okay, you can't count real estate, you cannot count hard assets, even though you might own them free and clear. They are looking for liquidity. So if you have $750,000 that you want to put into an annuity and you're looking for the highest payout, you can do that, but you really should have $1 million cash. Right? You need to have 250,000 outside of that lying around somewhere. Okay. In another brokerage account, Roth, traditional, it doesn't matter. Cash, you need to make sure you have some liquid outside of it, because insurance companies charge surrender charges if you cancel these. Okay. And sometimes people have emergencies and they got to cancel, or they got to take more than the 10% allowable that's allowed as a free withdrawal. But we're trying to protect you from this, okay? So you just keep this in mind. When you buy annuities, you want to use not more than 75% of your total liquid assets, okay? That is what they're looking for, okay? If you can use less, even better. If you lose 50% or 20% or whatever, use the amount that you need for income and no more, okay? Make sure you have plenty of liquid outside of that. So that's just a disclaimer I wanted to say, because a lot of people reach out to me and they're like, yeah, I want to buy this annuity, and they'll try to use all their money. I'm like, you can't do that. The insurance carrier will reject the application. Okay. So you have to just make sure you have plenty of liquidity. So anyways, I hope that helps. Hope that's answering your questions. If you have more questions, I would invite you to watch my other videos on my YouTube channel. There's so much out there, and I share lots of different angles, answering questions in different ways that really help people kind of get some clarity as they research and decide what they want. So otherwise, go to my website, johnstevenson.com, use my annuity calculators there. And then if you feel comfortable, reach out to me, book a Zoom meeting, and we'll chat. I'd love to help you buy an annuity. If that's what you're looking for, I'd love to help you. So again, I show everything that's available. Okay. It does not matter to me what you buy. Okay. Some of these will pay me high commissions. Some of them will pay me low commissions. But in the end, I want you to at least see what's available so that you can make the best decision for yourself without feeling like someone like me is going to come along and try to sell you something and convince you to buy it. And then you find out later there's some other annuity contract out there that pays more, right? That is the worst. And unfortunately, I deal with so many people that have done just that. Like, they've been sold something, they trusted that advisor, and it wasn't the best. And they didn't know what to ask. They didn't know what questions to ask. And so they bought the annuity hoping it was the best. And then they start browsing around after a few years and they realize, wow, that was good for that, but it was not good for what my goal was. Why did he sell me that? And so a lot of times I have to replace those. And I can do that. If you have an annuity contract that's like 2 or 3 years old, they have to be at least 2 years old, sometimes 3 years old, depending on the carrier. And you have to have a bonus to replace those. And typically when I do replace those, you get a lot more income than what you would have had. I mean, you have to have. I mean, if you don't have higher income, we can't replace it. So anyways, if you have something like that and you had to, if you're looking at something to replace it, let me know. I'm happy to help. So some of the carriers best for replacements is like American Equity, Athene, Equitrust is good. They require 3 years. You got to be at least 3 years old on your policies to replace them. So anyways, I just want to kind of share that because some of you do have old annuity policies and you're looking to replace them. You're looking to take advantage of really good rates right now. Just keep those rules in mind. So again, I'm happy to help. And if you're just looking and you're browsing, then use my calculators. If you got just questions, you don't want to book a call, then just comment below. I'm happy to answer those questions. So I hope you liked the video. If you do, like, subscribe, share, comment below, and we'll see you next time.